Altria Group Inc. ticker symbol MO is currently sitting at $46.74 a share. It is down 9.3% over the last year, but the reason why investors love this stock is the massive dividend yield, 8.04%. We're going to be talking about that dividend in the video. Is it safe, and how and when it will be paid to you if you own this stock? So what we're going to be doing today is taking this to my stock valuation spreadsheet, looking at the discounted free cash flow model, the Ben Graham formula, and the comparables company model to see if MO is a buy or a sell. Now, as I said before, the stock is down 9% over the last year from its bottom of the last year, which was around about $40 a share. It has been growing up 15%. If we take the stock to the last 5 years, even at the bottom of the pandemic, which was its lowest, it was at $34 and has had a pretty strong rebound up to $36. Now, it did hit a recent high of $56 a share, but can it get back up to there? That is the question we're going to be answering. Firstly, let's just have a little talk about the dividend. This is the $3.76 per common share. If we look at Altria's previous payouts, you can see it has been steadily increasing since 2009, and next year will be, or this year I suppose, will be the highest dividend payout they have ever done. Now, they did have an update, and it was a regular quarterly dividend of 94 cents a share, payable on the 28th of April as of the 24th of March, and that is the ex-dividend date, so you've got to be holding on the 23rd to get paid in April. And that is also, if we go to my stock summary sheet, this is what we'll be telling here. So if I enter ticker symbol MO, Altria Group Incorporated, 83 billion, $46 a share, dividend, once again, 8.05. That is the dividend per share, and the ex-dividend date, as we said, is the 23rd of March. So firstly, we look at the PE ratio. This is the price to earnings ratio. Is it lower than the market? Yes, it is. 14.66 to 21.65, so that is a pass. Next, we want to look at the revenue. Is revenue increasing? Once again, yes it is, but you can see it's slow revenue growth over the last 4 years, 19.8 to 20.7. So yes, it is up, but slow growing again. Profit, is the company profitable and is it growing? Well, in this time it was minus 1.3 billion up to 5.7. Now, if we look at the pandemic years and the subsequent year, 4.4 and 2.4, so it had a very strong year in terms of profit. It's been able to increase the amount of income compared to the revenue, which is what we like to see. Next is MO buying back their shares or issuing more shares. Well, you can see they are buying them back steadily. So 1.857 billion to just over 1.804. So that is a pass as well. It's all looking very good. And finally, as you can see from all the passes, we have a final green. Is the free cash flow increasing? Yes, it is. 7.6 billion to just slightly more than 8. Now, the reason for this is we like free cash flow because the company can use it to growth, it can pay down debt, and it can pay more dividends. And the free cash flow ratio is about 10, which is lower than the PE ratio, which is good to see as well. So in terms of the dividend, it's a massive dividend. Is it safe? Well, the total dividends paid is estimated based on this to be about 6.7 billion, and with a free cash flow dividend payout ratio of 83%, which is a little on the high side. Now, if it was, say, 100%, that would be an unsustainable dividend. Anything higher than about 90 is unsustainable, but currently it is on the high side, but not a problem right now because they do have that free cash flow and it's been pretty solid. So let's have a look at the discounted free cash flow model. This calculates the future free cash flows, discounts them to today, and then gives us a value of the company. I have a feeling that this will like the stock, but judging from the original numbers, we can see that it is a little bit low. Yes, calculated stock price of $4.12. Now you can see the calculated free cash flows are only $500 million. So let's have a look at the numbers and see why that is. Well, firstly, if we look at the revenue, analysts are expecting sort of over 1% growth for the next few years. So I think this is a fair estimate here. 2020 had a good year and then it was down in 21 and negative in 22. But analysts do expect growth, so I'm happy with this number. Net income margins, well, you can see in 2019 they weren't profitable. So what we're going to do is we're going to remove this value here, take an average of these ones, which puts us at about 20%. Now that puts the stock at a $6 stock. But the main reason here is this free cash flow rate, minus 600% in 2019. So what we will do is we'll take an average of these, which is 219%. What does that give a stock price? Well, $72 a share. And you can see these free cash flow estimates are a little bit closer. Now, I do think that is a little rich. What we'll do is we'll bring it back to, we'll see at 140%. That would put it actually fairly valued, which would be lower free cash flow and decreasing free cash flow. So let's go on the assumption that the free cash flow is increasing. We'll go to 182%, which is about there, $60 stock. So discounted free cash flow really does like this stock. Next, we look at the Ben Graham formula. This is a valuation of growth stocks created by the father of investing himself, Ben Graham. And what this does is it takes the earnings per share compared against the PE ratio of a non-growth company, the expected growth, the corporate bond against the AAA corporate bonds. So let's have a look what analysts are expecting Altria to grow over the next 5 years. We go to Yahoo Finance. We can see that over the next 5 years, 4.64%, pretty much the same growth as the prior 5 years. So we've got that there. And the AAA bond yield is displayed here, still 4.56. So what does the Ben Graham model say? Well, actually, it has a fair value of around $49.99 and a Graham price, which is sort of a big margin of safety, $37.49. So based on the fair value, it is a little bit undervalued at the minute. So that is good to see. So two of the models say it is a buy. And finally, we have a look at the comparables model. So what is this? Well, it compares, it's used to evaluate the value of a company using the metrics of other businesses of similar size in the same industry. So the ones I've compared it to here are Philip Morris, Inc. and British American Tobacco. And what it does is we look at the equity value, which is market cap plus debt. And then we have a series of metrics here. Enterprise value over revenue, enterprise value over EBITDA, which is earnings before interest, taxes, depreciation, and amortization, and then PE. So we have all the ratios of the companies, and then we have the formulas here that give a valuation based on all of these metrics. So if we look at the EV to revenue ratio, well, firstly, we can see that MO is about the middle, towards the higher side, 3.86 and 5.1. What we look for here is lower the better. So it's not as high as Philip Morris, but slightly higher than British American Tobacco. So I think this is a good estimate of that initially. Then we look at the EV to EBITDA, and once again, we want a lower value, and MO is once again in the middle. And in PE ratio, it's also in the middle. So I think this will be quite good. Let's see what the model has. Well, based on the EV to revenue, that would give a fair value of around about $45 a share. The EV to EBITDA, 44, and the PE around about 44. So the average implied value is 44.67, which is slightly less than what the stock price is now. So all models are either saying it's a buy or about fairly valued, which is good. But then obviously we do get paid that very nice dividend. Right, guys, thanks for watching. Please give a like on the video if you enjoyed it. Subscribe if you're not already. And I'll catch you guys next time.